of worker co-ops. And today we're going to be focused on income taxes for worker co-ops. And we're here with Bruce Mayer, who has supported us in the past to be able to facilitate this session. A little bit about Bruce. He's a accountant for cooperatives for a long time, and he's going to be reviewing the information for a long time. And he's also sharing how the new law impacts the different, will make your financial decisions and operate your worker co-ops. This primary audience is going to be, it's going to allow space for question and answers at the end. If you have any questions, please put them in the chat. We thank Bruce Wegner also for supporting us in this session. And I'm going to pass on the microphone to Bruce.
Okay. Hello, everybody. As mentioned, my name is Bruce Mayer. I'm a partner at a CPA firm in Madison, Wisconsin. And I have been working with co-ops for many, many years, and hope to go through some things about income taxes for your worker co-op. There is quite a bit of technical information here, but fortunately, the slides should help you if you don't catch something the first time. And we do have a co-op blog on our site. And of course, the US Federation has resources which are listed at the end of this and on their website that you can look at. So we are going to cover income taxes for a worker co-op, and we'll go over a little bit two of the government programs that were applicable this past year, the PPP and ERC money, and then talk a little bit about how you would report any activity from the co-op that affects your personal taxes. So we can go on to the next slide. And I did want to emphasize that we are only talking about income taxes for your co-op and not all of the many other taxes and fees that you have, and list a few of them here just for you to think about whether they apply or not. And the one additional thing I would put in is that states are rapidly changing how their rules work. And so especially if you operate in more than one state, you do need to be thinking about things like whether what you are doing is subject to some sort of tax in another state. So we could go to the next slide. And this just lists a few more things. If you have a member or an employee in a state, you do need to register there. And there are employment taxes of all kinds. And I would certainly recommend that you use a payroll service to do your payroll and not try to do that yourself. It's really much too complicated. And the cost of making an error is very high. The penalties are very steep on late and unreported payroll taxes. So next slide. So the first thing with income taxes for a co-op, and one of the challenges for advisors working with co-ops, is that you need to know what kind of co-op you have. So are you a co-op corporation or an entity that's taxed like one? So that's the subchapter T co-op that you hear about. That is what a traditional co-op is, a co-op corporation, subchapter T, or a fairly common worker co-op form is partnership. And if you started an LLC or an LCA is a limited cooperative association. Some states offer that, most states do not. But if you have one of those, you're generally defaulting to being taxed as a partnership. So it's important to know which of those two options you're starting with. And then there's two other options we'll talk a little bit about. But next slide. The first other option is S corporation. There are not many of these, and it doesn't really work very well with a co-op, but there are some. And then tax exempt. And this is really the only co-ops that I regularly see that are tax exempt are housing co-ops that work with people who have lower incomes. The IRS does not readily grant exempt status, and so just being a co-op is not enough to get tax exempt status. So this doesn't apply to, really, I have not seen a worker co-op that this applies to yet. Some folks have incorporated this way and then run into trouble with the IRS. So anyway, you're probably not under this status. If you are, hopefully you know and are sure about that. So we will spend the first part of the talk on co-op corporations. And so this is probably the longest single section, since this is the most common form of co-op. But you file the form 1120C, that's an IRS form. And then usually you'll have a state tax return, and then in some cases, a city return. And the due date is there. Most worker co-ops are a calendar year and will file either April 15th or get an extension. And it's important to note that the last item there, you should be filing from the time you are incorporated, even if you don't have any economic activity. Some states insist on that. For instance, California and New York, if you don't file that return, they will penalize you for it. So you really need to. Some states don't really care, but you need to know which of those states you're in. Ideally, you should just file right as soon as you get started. And then one thing to note with a co-op corporation is that you can have a year end other than December, and it's easy to change year ends. That's different than any of the other entities. Partnerships can't do that, and S corporations can't do that, but a co-op corporation can. And another advantage of the co-op corporation is that if you don't owe any tax, there is no federal late penalty. So you could file your taxes a year late, and if you didn't owe any tax, the IRS is not going to penalize you. That may well not be the case with your state tax return, but at least that is how the IRS deals with corporation tax returns. And the other item, the last point there, is that a co-op corporation is a subset of C corporations. And there's often, when you go through questions from your bank or insurance company or something else, and they ask you, what are you? Co-op will typically not be one of those options. And so you say C corporation. And then an advantage of a co-op corporation is that you get a choice about paying tax at the co-op level or paying tax with the individual members using patronage dividends. And so that's an important distinction from the other entities. Partnerships and S corporations don't have that choice. And the tax rate that you would pay if the profits are left in the co-op, the 21% federal, and then the states, an average might be 8% at the state level. And if you do if you do leave money in the co-op to be taxed, then that adds to your retained earnings, or sometimes called permanent reserves of the co-op. which again is a distinction from how the other entities work. And then I won't go through everything on this slide, but an important point is that you can allocate your patronage dividends. Let's say you could look at your 2021 profit and allocate it to yourselves in 2022, and the co-op would deduct it back in 2021, but it would be income to you for 2022. And that can be fairly confusing. That is a very unusual feature of a co-op corporation. With a partnership or an S corporation, the profits are always taxed in the year that they're earned, but in a co-op, you can defer that for 1 year. So that's an important distinction with a co-op that you can take advantage of. And then an important issue for co-ops is that you do need to have patronage dividend wording in your bylaws or your operating agreement. And so that should outline for you the basic rules of how your patronage dividends work. And in most worker co-ops, you allocate patronage dividends based on hours worked. I think that's probably on the next slide, but in this case, the IRS phrase that they apply is business done with the co-op. So in a food co-op, that would be how many groceries you buy from the co-op would be the measure of the business that you do. In a worker co-op, it's how many hours do you do, how many hours have you worked on the co-op's business. And so different bylaws may define that somewhat differently, but that's the basics. Next slide. And that just mentions that, and that there are other ways to measure that in food co-ops and so on. Next slide. And there's an example here, and really it would probably help if you wrote this out or put it in a spreadsheet if you were, especially if you're the person responsible for the books at a co-op and you're not quite sure how this works. So I'll do a little bit of description here. The first thing you need to do is determine what your profit base is for your patronage dividends. And in most co-ops, that is your federal taxable income. Typically, your bylaws would define the starting number for your patronage dividends to be your taxable income. They may use other wording, and you can sometimes decide if you want to have more or less patronage dividends. You can potentially change depreciation methods or some other way that you're accounting for things, all within the legal, what's legally allowed by the IRS. And this is your taxable income before any losses you carry from prior years. The next slide. And so once you have the base that you're going to use for your patronage dividends, you would then apply a formula. And this is just an example of how you would allocate to your members. And so it depends on how many hours people worked, how you're going to allocate to them. Next slide. And this is where putting this on a piece of paper or in a spreadsheet to work out to make sure you understand it. This lays out that it's somebody who worked half of the hours in your worker co-op would get allocated half of the profit. Somebody who worked, in this case, member B, they worked 1/4 of all of the hours in the co-op, so they would get 1/4 of the profit allocated to them. And then it is important to note the last point there that folks who work in the co-op who are not members still get allocated based on the hours. That would generally only be someone who's an employee and not somebody who is a contractor. But you do need to allocate to your non-members, so you may not be able to allocate 100% of the profits to your members. And this page just summarizes the result and shows how much each person would get. And then also the very last point indicates that you can do a patronage dividend to your non-members. It's unusual for that to happen, but I have worked with some co-ops where we did do that, and it is clearly allowed by the IRS, but just not very common. You typically want to encourage people to be members. And then the next point is, after you've determined the total amount of patronage dividend that you're going to allocate, you can then pay that out partially in cash and partially as equity in the co-op or retained amount. So the IRS requires that you pay out 20% in cash. So for member A, they got allocated $10,000 of the profit, and you need to pay them out at least $2,000 in cash, and that means a check or whatever, not part of their payroll. And then the other $8,000 would be retained as an additional member equity, member investment. So then this just totals up the numbers from the last page and then indicates that the portion that is not a patronage dividend is taxed. And so that amount is then subject to tax at the co-op level. And so the co-op would end up paying some amount of tax during the year. And then what's left over from that profit that is not allocated to the members and is not paid out in tax becomes part of the retained earnings of the co-op. And then another important point is that you do need to issue a statement to your members indicating that you have allocated a patronage dividend to yourselves, and the portion that you are paying in cash and the portion that you are retaining in the business, in the co-op. Typically, issuing this notice is one of the things that's mentioned in your bylaws. And I have a sample wording on the next slide, I think. Oh, no, the one after. But this one, you do need to tell people how much you allocated to them. That's the key information on there, is that we are allocating you a profit, and a portion of it is coming to you as cash and a portion of it is not. And then you report that to them on a 1099 PATR for the year, the calendar year in which you issued them the notice. And yeah, if you look, this is the wording that you could use as an example of what you should send, and it doesn't have to be anything formal. It could be an email, but this just makes clear to people that it is in your bylaws, and then the amount that you've allocated to them, and then when it will be reported to them on the 1099 PATR. So you could certainly lift this sample wording to allocate. And then if you do get into the details of the patronage dividends, this is called a qualified notice of allocation. And you may have a discussion of that in your bylaws. There is one other option, the non-qualified, but really worker co-ops don't use that. If you are going to use that, that's something that you would want to research further. And we won't talk about that today because it's very, very unusual, but is an option if you wanted to look at that. Okay. So that was the end of the longest section. And so if there are any questions that you wanted to throw to me here, Anna, we could talk about those now, or we can wait. Up to you.
Hay algunas preguntas en el chat. No sé si Ana Martina, yo debo leerlos primero o bueno.
I can see one from Alice
Ajá.
that is asking, can you bonus out the profits instead using payroll? Will there be advantages or disadvantages to that?
Sure. Some co-ops do use payroll and report it on the W-2. In that case, you would not give somebody the 1099 PATR. The downside of that is that you pay more tax on W-2 wages than you do on a patronage dividend. Payroll wages are subject to all of the Social Security taxes, typically also unemployment tax. And so the patronage dividend payment is not, it's a payment of profits. And so it's different than wages. It's what a business owner would get for owning this business, or that's what it's supposed to be. And so there is also, and we'll talk about this a little bit later in the presentation, there is also a tax break for profits allocated to owners called qualified business income, or QBI. And so patronage dividend is qualified for that, but W-2 wages are not. So ideally you would do this as patronage dividend and not through your payroll system.
There is another question from Luis Sierra. In a co-op with nothing to depreciate, will taxable income be the same as what's on the co-op's financial statements?
Usually, yes. There may be some other differences. There are quite a few things that may be different between taxes and books. But generally speaking, you are correct that without any depreciation, your book income and your taxable income are probably the same.
There was another question asking if the majority of accountants will be familiar with the subchapter T.
I'm sorry, what about subchapter T?
They were just asking if that's a term the accountants will be familiar with, or they will know how to handle it.
Probably not. Not that many accountants understand about co-ops. But if somebody does know something about co-ops, subchapter T is a portion of the Internal Revenue Service Code, all the laws that govern taxes. And so if you talk to an accountant who doesn't know what subchapter T is, then they don't know what co-ops are, certainly, and probably are not the right choice for working with you.
There's a couple other questions. You know, I will just read it to you, and you can continue with the presentation after it. From Zen, in a worker co-op where all employees are members, but there are also contractors paid via 9099, can 100% of the net income be allocated as a patronage dividend without having to pay any tax at the co-op level? IIRC surplus attributable to a non-member employee labor is subject to tax at the co-op level?
Let's see, I understood the first part, which is that if you are using contractors, you do not need to use their hours in your calculation, and you could allocate 100% of your profits to the members, and the co-op would then probably not have any taxable income. There was one last piece of that question I'm not sure I understood.
Yeah, I couldn't understand the question exactly. I will read another question, and I will let you continue with the presentation. So Luis Sierra is asking, if a co-op has a manager that is not a member and they want to provide a bonus to the manager, will they use a portion of net earnings to do that?
If you have somebody who is not a member of the co-op, you could allocate them patronage dividends based on the hours worked. But if you wanted to base the bonus on something else, you would need to run that through the payroll, W-2 payroll. Or it's possible that your manager is being paid as a contractor, and then you would just report that on a 1099 NEC. But if you do patronage dividends, it needs to be consistent how you're doing it, and it needs to be in relation to the number of hours that people worked.
There's one last question that came in Spanish. I'm going to actually read it in Spanish since I know that you have interpretation.
Español.
Dice, me confundo con los impuestos.
Taxes confuse me. I feel like we pay twice for calculating them. If it's a guaranteed payment, does the co-op pay and the member pay over the same income, especially with K1?
Okay. This next section is about partnership tax, which is where guaranteed payments and K1s are. But the basic answer is no. The tax only gets paid once. It's either paid by the individual, which the individual pays tax on the guaranteed payment, and it's not paid by the partnership, which is deducting that guaranteed payment. And partnerships don't really pay taxes on their own, except in a few states like California. So anyway, but I'm getting into that next section on partnerships now. And the term guaranteed payments doesn't apply to co-op corporations. So it's only in partnerships. So I'll start in on the next section, the next major section, which is co-op partnerships. And these partnerships file Form 1065, the partnership form, and then there's normally a state and possibly a city return. And they have a different due date than co-op corporations. And it's important to file these returns from the first year that you set up. There are significant penalties for late filing. And I've definitely seen partnerships where the IRS insisted that they pay these penalties. So you want to make sure that you're not late with filing for a partnership. And an important point is that a co-op partnership is not different in any way than other kinds of partnerships. Co-op partnerships are not part of subchapter T. And so just need to know that. There are certainly good reasons that you may want to have a partnership co-op, but it is not subchapter T. And then the individuals are the ones who pay the tax. There are just a few places where tax is also paid at the partnership level. And those are listed. The tax that is probably the highest of all of those is in New York City, which those of you who work with New York City worker co-ops probably know the UBT tax there. But there are taxes in these places, and there are potentially some in others as well. But normally it's the individual that pays the tax and not the partnership. And there is income that gets allocated to the members. There's none that would stay with the partnership, so you can't build up any reserves. So that's an important point. And the other one is that you can allocate profits to your partners, but you don't have to give them any cash. So you can withhold a portion of the profits, and people have to pay tax on it, but you can hold that as a form of reserve. But everything that the partnership has belongs to one of the members. Okay. And then the profit is calculated on the partnership tax return, and then it is allocated to the members on the schedule K1. So the K1 is what everyone receives that tells them how much of the income, what their guaranteed payments were, and so what they need to pay tax on. And as we mentioned before, the guaranteed payment is the partnership term for a salary or wage that's paid to the member, and then they pay tax on that. And the allocation to the members happens in the year that the profit is earned. So when you get your K1 this year in 2022, it will be taxable on your 1040 for last year. So you need to wait until your partnership tax return is done to be able to file your own personal tax return. And then the one way that a co-op partnership differs from other partnerships is that normally the percentage allocation of profit is based on hours worked. In other kinds of partnerships, it is normally based on the ownership amounts, so how much people have invested, and that portion of the investment is how much they get allocated of the profits. So in a worker co-op, that's different, and then we'll go through the same sort of allocation as we did with the co-op corporation. And in this case, the co-op partnership has the same taxable income, the $20,000, and it has to be based on federal taxable income in a partnership. And it is after depreciation and so on. Next slide. And then in this case, the non-members are not going to be allocated anything. Since they are not actually owners, you cannot give them a profit allocation. And so in this case, your profit would be allocated between the two worker members based on the proportion of the hours each of them worked. Next slide. And so this shows, and you would need to line up the slides for the corporation versus the partnership if you wanted to compare how this worked. But this goes through how the profit allocation works, and that it goes 2/3 to member A, 1/3 to member B, and there is none that stays with the co-op partnership. So there's nothing that the co-op partnership will pay tax on. And this just totals up the profit allocation, and that the non-members don't get anything. And generally speaking, a non-member of a partnership should be getting a W-2. It's possible that they would get as a contractor, a 1099 NEC for their work, but they would not be getting a K-1. And this just summarizes the amount and the fact that those amounts will get reported to those members on their K-1, and that you don't need to pay any of that out. Now, obviously, member A and B control this co-op partnership, and so they can decide how much to pay out or not, but they don't need to pay any of it out to themselves. And this just goes through what happens when there is a profit that is not paid out and it becomes part of the equity of the co-op, but it belongs to the individuals, and they need to decide how long the partnership will retain those equity amounts. And probably the biggest issue in a partnership is when there's a membership changeover and somebody has equity in the co-op, and how long it's going to take you to pay it out, or whether somebody leaves that equity behind. I've certainly worked with a number of partnership co-ops where somebody leaves and normally there's not a lot of equity left in, and they just leave it behind, which you can decide to do. So that was the section on co-op partnerships. So I don't know if there were any questions that came up in relation to that or anything else.
Yeah, so I have a question from Marco. It says, we have a multi-member LLC that pays via owner draws. We set aside some of that pay for quarterly payments. If the business retains some of the profits, how does the business pay taxes on cash retained?
Yeah, if you have an LLC that is taxed as a partnership, which it sounds like, an owner draw is basically the same thing as a guaranteed payment. There wouldn't be any profit that the co-op partnership would pay tax on. So the business can retain a portion of those profits, but it's still in the name of the members. So the business is not paying tax on the cash retained, the individuals are. So as I mentioned, you can have a profit and the individuals pay tax on it, but they don't get any cash for it. So that is what's happening here. If the co-op is withholding an amount for quarterly taxes for the members, that quarterly amount presumably will get paid out to the members so that they can pay their personal taxes. But it is taxable to the individual member, whether it gets paid out or not.
There's another question from Luis Sierra who asks, what do you think about the practice of taking a portion of net income and not allocating it to members so it becomes co-op's permanent unallocated equity?
Sure. And you can do that in a co-op corporation, but you can't do it in a co-op partnership. And I know that folks want to do that in co-op partnerships, but there's not really any way to do that. If it is a co-op corporation, then retaining permanent unallocated equity makes a lot of sense. It depends on what kind of business you have, how much you need to retain, whether you need to invest in equipment or something else or not. Many worker co-ops don't need a lot of savings or permanent unallocated equity. because they don't have a lot of need for that. But I think it's certainly a good idea. If you want your co-op to survive beyond your current members, generally you need to have some savings.
There was a question from Molly. I think it came up when we still were talking about cooperative corporation, but it might apply here as well. If there are employees who are not members in the co-op, do their hours count for calculating patronage percentages?
Their hours would count in a co-op corporation, but they would not count in a co-op partnership. So you do need to take into account your non-members if you are doing patronage dividends in a co-op corporation. And normally bylaws will make a distinction between the hours of members and the hours of non-members, sometimes calling, I can't remember how they usually do it, but one of them is often called net profit, and I can't remember what the two terms are, but they're usually called different things to distinguish between member hours and non-member hours and how you allocate the profit.
Those are all the questions that I have for now.
Okay, great. So there's a section here on S corporations, and I won't spend a lot of time on them because there aren't very many, and they actually don't really work all that well as a co-op. If you're very small, an S corporation might work 2 or 3 people with no non-members. But it would be hard to make an S corporation work based on the restrictions of the IRS rules. But just to run through, the form is an 1120S, and it is a very common ownership form for non-co-ops that are owned by one, 2, or 3 people. So if you're in a co-op conversion, it's likely that your current owner is one person and they probably own it as an S corporation. So you may want to understand this. But the S corporation tax return is due just like a partnership, 2.5 months after year end. It can be extended, has to be a calendar year, and there are penalties if you file it late. Next slide. And there is no difference between a co-op S corporation and any S corporation, any other S corporation as far as the IRS is concerned. You're not subject to subchapter T. And all tax is paid at the individual level, except in certain states where the S corporation does have a secondary tax attached to it. But generally, all of the profit will be taxed to the owner or owners. Next slide. And as with the partnership, there cannot be reserves in an S corporation. And you will get a K1 that indicates to you the amount of the profit that you're allocated. And in this case, it's not guaranteed payments. Owners of S corporations get wages and receive a W-2. So that's fairly clear. You'll get a W-2 and a K1. So in that sense, it's a hybrid where in a partnership, you only get a K1, and in a worker co-op, generally speaking, you only get a W-2. In an S corporation, you get both. And then all of the income or loss is allocated and taxed in the year that it's earned. And that's doesn't matter if you're cash or accrual basis. Everything gets taxed to you in the year that the S corporation earns it. Next slide. And S corporations are very strict in that you have to allocate profits based on your percentage ownership. So this is one of the reasons they don't work very well as a co-op unless all of your members are working roughly equal amounts. Your profit allocation won't really mirror the business done with the co-op, which typically is what people are aiming for. And you can't base your profits based on the hours that people work. It has to be based on their ownership. Okay. And so that was it for S corporations. So we'll talk a little bit about co-op exempt organizations. And as I mentioned, very few co-ops qualify for this. Just about the only ones that I see are housing for low-income individuals, housing co-ops. Oftentimes, student housing co-ops associated with a college or university are the most common, but there are certainly others that may qualify. And you file the forms here, 990, and you have the due date at 4.5 months after your year end, which you can extend. And there are significant penalties if you're late. The nice thing with tax exempt organizations is that if you get a late penalty and it's not something that has happened previously to your organization, the IRS will often waive that penalty if you ask them to. But if you don't, the penalties can be quite steep. $20 a day adds up very quickly if you're late with a 990. And the other thing to note is that the IRS does not recognize these entities as a co-op. There are a few kinds of co-ops that actually are exempt organizations. There are rural electric utilities and credit unions that are actually under the nonprofit section of the IRS code. So they actually are co-ops and tax exempt at the same time, but that doesn't have too much to do with worker co-ops other than that they are related to you in being co-ops. Next page. And just to mention here that one reason that exempt organizations don't work well as co-ops is that you cannot really allocate, well, you can't allocate anybody equity, and you have to be very careful about taking advantage of the nonprofit. An exempt organization needs to have a purpose that benefits everybody in your community. And so it can't just benefit its members. And a co-op is really set up to benefit its members. And it often has a mission of benefiting the community, but it's not a required part of the economic piece of a co-op. And so in an exempt organization, you do have to be careful. You can't allocate profits to people. Next slide. And then the Form 990 is really different. And there's no pass-through of any income to individuals. And so it's not really something that we need to talk any more about. It is really a very different reporting than for other kinds of co-ops. Okay. And I will just talk about a few things that are different this year. One of them is that for pretty much all previous years, any meal that you have when you're traveling or having meetings with clients of your co-op or something like that were only 50% deductible. But tax break that was passed allows 100% deductibility for 2021 and 2022. A small point, most worker co-ops don't really have much in the way of meals, but if you do, they are now fully deductible. The PPP loans, which there were 2 rounds of, many co-ops did qualify for the first round because it went out to almost everybody who was eligible. And then the second round, which was more restricted, but both of those are over. And the main question now is if you obtain forgiveness, is it taxable? And for federal purposes, they are not subject to tax. For most states, they are not subject to tax. There are a few states where they likely are taxed, or there's some rule where a part of it will be taxed depending on other circumstances. So I've listed there some of the states where it's likely to be taxable. The biggest one that I've run across is California and then also North Carolina. So you just need to be aware that may or may not be taxable. And the other thing, which I'll mention just briefly, is that PPP loan forgiveness can be part of your calculation of patronage dividends for a co-op corporation. This is not a clear-cut area because there is no IRS guidance on it. But I think that other co-op accountants that I have heard talk about this have agreed that they felt like you could use the income from PPP loan forgiveness as part of your total income in calculating your patronage dividends. Now, there are some co-ops whose bylaws would restrict them from doing that, but there is no IRS restriction on that. And from the logic of patronage dividends, I would certainly interpret that you could do that. So just throwing that out there, if that's a question anybody has been wrestling with. I actually just received an email 10 minutes before this talk from somebody asking me what my opinion was on that. So anyway, next slide. And then the other point here is about the ERC or employee retention credit. Most worker co-ops probably don't qualify for this, but if you did, or if you do, these are some of the rules that would be for qualification. Basically that your sales amount went down significantly from 2019 to 2020 or 2021. The primary co-ops that I work with that qualified for this were were food co-ops where they had a local government order restricting their business. So their deli shut down, their in-store eating area was shut down. In some cases, their sales were significantly lower. Most worker co-ops would not have qualified. The good news is that if you do qualify, you still have plenty of time to claim this. It is claimed by filing an amended 941, which is your payroll tax form, and you have 3 years after that form was due to make a claim for this credit. So if you did have a significant fall off in your business related to the pandemic, this is something that you should take a look at. The other side of this is that the federal government and most states will tax the employee retention credit. So if you do get that, it will be part of your taxable income. And this just runs through a little bit of the rules on that. We did have some webinars on the website of my firm where we talked a little bit about that, so you could follow that link. And there's plenty of resources out there if you take a look and see if you might qualify or not. If you do qualify, it can be a lot of money. So you want to at least give it a quick look and see if it might apply. And then the next section is going to be about your taxes. And so how the co-op's income affects your personal taxes. And one thing to say is that when you are a member of a co-op, you are owning a business. That is the formality of the situation, and business owners typically have complicated taxes. So for better or worse, it just comes with being a member of a co-op, that one way or another, your taxes will be a little more complicated than they were than if you were just being an employee of another business. There's some general advice below, so you can go to the next slide. And I did update an article that's on our website. I didn't put the link in because I just updated it in the last week. But if you go to the Wegner CPAs.com website, there is an article that I just put out there that gives a little bit more background. But these slides give a summary of how to report. And I'm not going to go into great detail on where to report things. But the 1099 PATR is an allocation of profits. And so it is reported differently than your W-2 wages. And so there's a question about where do I put this on my return? It is not common. And so tax preparers and tax software are not really set up to deal with this unless you're a farmer, which for most of you is not the case. So the main thing is that your 1099 PATR should not be subject to self-employment tax, and it should qualify for the 20% qualified business income QBI deduction. So I give you the technical code section citation here so that if you do have a tax preparer who's questioning you on that, you can tell them that's where they can look. And the QBI, it is a significant tax break in that 20% of the income on your 1099 PATR will not be subject to federal income tax. So that it's not a really large break, but it is definitely a tax break. Next slide. And as I mentioned, you should not be paying SE, which is self-employment tax. And that this is very important because the self-employment tax is about 15%. So paying that or not paying that makes a big difference in how much money you owe. If you were part of a partnership and got a K-1, it is subject to this self-employment tax, and there's no question about that. But in a worker co-op, the 1099 PATR is not. I also give a citation here to an attorney who wrote a rather long article about why it should not be subject to that. And I have talked to a number of co-op attorneys who all agree that is the case. So next slide. It can be challenging to report it on your personal return, though. What I gave above was the technical reasoning and what the result should be. Actually getting your tax software to do this or getting your tax preparer to do this may be a bit of a challenge. Next slide. I'm not going to go into this in detail because it lists out line numbers in the on the actual 1040 tax return. The one thing I will say is that if you're using something like TurboTax and you fill out the 1099 PATR input sheet, it will probably default you to being a farmer, and farmers are actually subject to the self-employment tax on their 1099 PATR. So you'd end up paying that, which is not what should happen. So if you just describe what you have, 1099 PATR, in this case, the third point, profits from Co-op Blue, the federal ID number of Co-op Blue, and then the amount, that should avoid the self-employment tax. again, this can be a little bit of a challenge, but this is how things are supposed to go. Next page. And you can report this on the Schedule C, which is where individual owners of small businesses report their income. And the issue there is that tax software will default to self-employment tax on that income. If you have a tax preparer, they should be able to get around that with their tax software. Otherwise, you may need to make an adjustment to avoid that self-employment tax. Next slide. And so there is actually a Schedule SE where the self-employment tax is calculated, and in some tax software, you should be able to adjust that so that it's zero and you don't pay that tax. When you actually get to preparing your return, you might want to review these slides and the article on our website that I just posted about that. So it can be a little bit complicated, but if you stick with it, you do get some significant tax breaks. So it is worth working through this and making sure you get to the right result. Okay. And then there's just a little bit more detail. Personal taxes are more complicated than people think they are. And so there are lots of exceptions and additional considerations, which you may have, likely you don't, but you may. And so need to consider some of those. Next slide. And then the last thing is, if you do end up filing a tax return where you do not pay self-employment tax, there is a chance that the IRS will send you a notice saying, well, asking you, why didn't you pay self-employment tax? And so on the Federation's website, there is actually a guideline to how to respond. And as far as I know, everybody who responded with a letter that was something like the example on the website did not have to pay a penalty or pay that self-employment tax. So the main thing is to be sure that you respond. Ignoring IRS letters is almost never a good idea. So next page. And then briefly on partnerships, the K1 gets reported on your 1040, and the K1 is a standard form, so you really should not have any problem doing this in TurboTax, doing it with a tax preparer, and so on. The biggest problem that folks have with partnership taxation is that they are subject to self-employment tax. And so there is no withholding in partnerships. And so you do often end up paying more tax than you think you should based on how the self-employment tax works. And you can see here that tax at the 15.2%. And so it's one reason that many people don't like having partnership co-ops, because they end up with all that tax to pay, and it can be hard for new members to understand how to work with their taxes. S corporations have very standard reporting, so you shouldn't have any trouble there. Likely there's less of an issue with paying the additional tax because you do have withholding on your W-2. And the other thing is that in S corporation, you actually do not have self-employment tax on the profit. It's one of the reasons that many small businesses end up as S corporations, instead of partnerships because they don't have self-employment tax on the profits. Next slide. Okay, so that was everything that I had, and I'm happy to go back through questions. You know, I think we have at least another 15 minutes if we need it. So,
Thanks, Bruce. So we have some questions from Stephen. For patronage purposes, does it matter if non-member net income is attributable to employees or contractors? That is, are the hours of contractors included in the total hours for purpose of calculating patronage?
right, contractors are excluded from the hours when you're calculating patronage dividends. It can seem a little bit odd, but that's how the rules are assumed to be applied. And so, yeah, you would exclude those contractors from calculating your patronage hours and allocation of profit.
Another question from Alice. Do you have to meet all of those tests for the ERC? How much of a credit will be the ERC be?
One of the hard things with ERC is that 2020 and 2021 have different rules. So your profit had to, or your revenue, the amount that you collected from clients or from selling things had to fall. It was 50% in some cases and 25% in others. So you had to have a large reduction in the income, the gross income of the co-op. And yes, you did need to meet those unless you had a government order that restricted your business. And that was the example I gave of the food co-ops that had to close their deli and so on. So it depends on what kind of worker co-op you have. And the amount is also variable. Basically, it was $5,000 per person in 2020, and it was $10,000 per person per quarter for 2021. So it's a much higher amount for 2021 than it was for 2020.
A question from Alice. Can you explain the QBR again?
Yeah, and I think it's QBI, the qualified business income. And that is a separate calculation on your 1040 that would take the amount on your 1099 PATR, and it would exclude 20% of that from income taxes. And in the slides above, I mentioned the form number and a little bit about how that calculation works. If it's reported in certain places on your tax return, the software should automatically take that. In other cases, you may have to override that. The rules on QBI get really, really complicated, but primarily those complications apply to people with very high incomes. So probably does not apply to most worker co-op members.
Elizabeth pregunta, ¿se puede usar Turbotax para
So
declarar?
Elizabeth is asking, can you use Turbotax to calculate a K1?
Yes, Turbotax should have no problem with the K1. It's a standard form. And so for either a partnership or an S corporation, it should be straightforward to enter that information into Turbotax.
A question from Theodora. To clarify, Bruce, you're saying that all LLC members do have to pay self-employment tax?
Yes. If your LLC is taxed as a partnership, then all of your guaranteed payment and all of the profit allocation from the partnership will be subject to that self-employment tax. There are limitations if you have, again, a high income, but generally, yes, it will all be subject to the SE tax.
A question from Molly. This is our first year operating. So did I understand correctly that the 1099 PATR we received for 2021 dividends will not be reported on our individual returns this year, but will be income for 2022?
Yeah. Assuming that you pay out that dividend on 2021 in 2022, it will be taxable on your personal tax return for 2022. So that's the key point, is that the individual pays tax on it in the year that that the co-op allocates the patronage dividend to them.
A question from Luis. Why isn't 1099 PATR entered on 1040 as qualified dividend?
Yes, dividend is a more general term that applies to a number of different kinds of payments. A qualified dividend is a corporate dividend that's paid based on your ownership in a corporation. And a co-op could pay a regular corporate dividend. It would need to be proportional to the ownership, which in a worker co-op is generally equal. So you'd pay everybody the same amount. And that would be subject to the qualified dividend. But a patronage dividend is an allocation of profits that's based on the work that you do for the co-op. And so it's not equal to your investment. So it's considered to be a different kind of income. It's not the same kind of dividend is the short answer.
Those are all the questions that I have. I just wanted to make sure that if somebody had a question they didn't ask in the chat, that this is their opportunity to ask in the chat, or if they cannot ask the question on the chat, also, I think that they might be able to unmute themselves. We have still 5-ish minutes for last question. Okay, so there are a couple questions, more than a couple. So is it true that the only thing certain in life is death and taxes?
Well, I don't know. That's maybe a question for a philosopher, but yes, there is no way around taxes if you want to be part of society. So I guess I'd have to say yes.
What's the best way to find a certified cooperative tax professional?
That's a really hard one, and I think it's a challenge for the whole co-op community. For instance, we are short of staff at the moment, and so we're actually not accepting any new clients. So I think the main way that folks find a co-op tax accountant is to ask around. Many of the co-op tax folks that I know are not taking new clients at the moment because they just have too much to do. So if you know anybody who's a 4-year degree accountant who wants to work with co-ops, there is a significant opportunity there for people.
In TurboTax, the 1099 PATR link goes to the farm page. Do you know if this will trigger self-employment tax?
Yes, it will. And so that's one of the reasons that you don't want to enter your 1099 PATR on that TurboTax entry sheet. if you just enter it as other income and you use 1099 PATR in your description, you've told the IRS the basic information, but you're getting around the programming in TurboTax.
And a last question, how does patronage refund tax compare to wage tax, different percentage?
Yeah, there have been a few co-op folks who have looked at the difference, and it's fairly significant. Patronage dividends save taxes to the co-op and to the individual compared to wages. And it depends on the state and which state you're in and other issues like that, how much the savings is. But it might be 20 or 25% savings if you calculate the Social Security and Medicare and unemployment, and then the qualified business income exclusion. The difference is actually pretty significant. So you can't pay out too much of your compensation as a patronage dividend, but it is certainly a good idea to allocate the profits of your business that way and not do it through your W-2 wages.
Okay, I think that those are all the questions that we got. Here's the information for Bruce. If anybody wants to reach out to him, I'm just gonna read aloud the email, bruce.mayer@wegnercpas.com. His phone number is 608-442-1939. And there is a website also that has more information for cooperatives. Bruce, we wanna thank you so much for doing this presentation with us every year. This presentation is recorded, so it's gonna be shared. If folks register for attending to the webinar, it's gonna be shared, and we typically have this information also available in our website. And just a couple announcements before we go. We just want to share the upcoming events that we're gonna have with the Federation. And the webinar for to start a worker cooperatives in Spanish will be happening on February 23rd on 2022. The worker co-op policy pools also will be happening on February 24th. We're gonna have a session specifically focusing on tax preparation for LLC cooperatives. And this is gonna be facilitated by Daniela Preisler. It's gonna be happening on February 28th. And you can read more of the information that we're having in our website as well. And this is a session within the series of webinars that we're presenting with Co-op Clinic, a space for offering technical assistance and support for worker cooperatives and other democratic workplaces. So I think that's all that I have for today. And once again, we want to just appreciate you, Bruce, for being here with us, and also for to the interpreters also that were with us, Ron and Susan, for making sure that we are trying to do a good job and making this information accessible for folks, including Language Justice, to Raquel also, who supported with the tech, and all the other folks that are in the Federation. Thank you so much, Bruce. And yep, I don't know if you have last couple things to share.
Just to say, yes, if people do have a few questions, you can send me an email. As I said, we unfortunately can't take any new clients now, but I'm happy to direct you or answer a few questions that hopefully get you going in the right direction. And good luck to everybody.
Thank you.